$65B in AI capex locked through 2026. When it doesn't deliver, your paycheck stays the same but your stock doesn't. Meta's betting its balance sheet on artificial intelligence. But the bet was structured during a bull market narrative, and the cash burn cliff hits right when your RSUs are vesting. If you're a tech worker holding significant Meta equity, the next 18 months matter more than the next 18 quarters. Here's why. Meta's capex cycle converges with 3 simultaneous headwinds in 2026, and the tax calendar makes the math worse than the stock price alone. By the end of this video, you'll understand exactly where Meta's $65B goes, why the ROI timeline creates a margin compression trap, and how vesting RSUs during that window locks in ordinary income tax losses in a way concentrated portfolios can't escape. Let's start with the capex timeline. Meta committed $37.40B annually to AI infrastructure in 2023-2025. That's front-loaded spend. Research into Meta's Q4 2024 10K shows something critical in the fine print. Expected AI infrastructure ROI is 2027-2028 at the earliest, not next year, not 2026. 2027-2028. That creates a 12-24-month cash burn window where margin pressure is visible but monetization hasn't landed yet. And here's the rehook. This window closes right when your vesting schedule accelerates. Historical precedent matters here. When Intel front-loaded capex in 2021-2022 for foundry ambitions, the market repriced the stock 40% downward before ROI materialized, even though the long-term thesis was sound. The stock doesn't wait for fundamentals to prove out. It reprices based on near-term earnings pressure. Meta could follow the same pattern. Meta's Q3 2024 guidance already embedded margin compression. The company signaled operating expense deleverage, corporate speak for expenses growing faster than revenue in 2025-2026. That's not speculation, that's in the filing. Operating margins are expected to compress by 3-5 percentage points during the peak capex years. Now here's where it gets worse for tech workers. Meta's capex isn't evenly distributed. It accelerates into 2025-2026, right as regulatory pressure on AI intensifies globally. The EU AI Act, potential US regulatory frameworks, and geopolitical compute restrictions all narrow the ROI window. Analysts at JP Morgan and Goldman Sachs have already flagged this, multiple $40B plus capex commitments facing a tightening regulatory landscape. If compute allocation becomes restricted by region or use case, Meta's expected returns drop further. But the real trap isn't the stock price, it's the tax calendar. Imagine you're a senior engineer at Meta with $500K in concentrated equity. $100K of that vests in 2025-2026. Under IRS publication 525, RSU vesting is taxable as ordinary income the moment shares vest, at a 37% federal plus state marginal rate for high earners in California. That's $37K in taxes owed on $100K of vesting RSUs. That's money due April 15th, whether the stock moves or not. Now the stock falls 30% during the capex disappointment window. That's a $150K paper loss on your position. In a non-concentrated portfolio, you'd harvest that loss, rebalance, and offset ordinary income. In a concentrated position where your income and your equity are both tied to Meta's execution, you pay $37K in ordinary income tax while realizing a $150K loss you can't fully offset against the vesting income. Here's the mechanism. IRS wash sale rules prevent you from repurchasing similar securities within 30 days. If you sell to harvest losses, you can't immediately rebuy Meta stock. That creates a forced diversification window, except you didn't choose it. The tax code forced it. The delta, $37K in taxes locked in while the stock reprices lower. You've lost twice, once on the vesting tax, once on the stock descent. This is why concentrated holders need to plan 12-18 months ahead, not during the vesting quarter. The convergence crisis is real. Chip supply normalization, TSMC and Samsung are expanding capacity by 20-30% through 2026, reduces Meta's scarcity premium for advanced chips. Margin compression from power infrastructure build-out at data centers is already visible in capex guidance. JP Morgan estimates power costs alone will compress margins by 1.52% in 2026, and regulatory scrutiny on AI compute allocation will likely narrow ROI windows further. All three hit in 2026, not sequentially, simultaneously. For concentrated holders and RSU earners, this creates a planning question. Can you structure vesting or diversification before the convergence window? The answer isn't binary, it's about tax-efficient timing and understanding your own liquidity constraints. Some employees can negotiate vesting schedules. Others can use collar strategies to hedge concentrated positions. If you want the full analysis with spreadsheet breakdowns and the exact filing citations, that's in the deep research linked in the description. The short version, the next 18 months are a structural inflection point, not a bounce-back opportunity. In strategy, the quiet observer wins.